Welcome to this month's CNBC Investing Club. It's our monthly call. I always want to say, hear ye. We thank you for taking time out to join us in the middle of the day. It's been a rough ride for the markets recently, so let's get right to it. I will bring in Jeff Marks in a moment when we go over your questions, but I was searching for metaphors of how to make it so that it was clear about this market. And I remember that 50 years ago, Carly Simon, you may remember her, wrote a trenchant song for our business. Of course, it wasn't meant for our business, with lyrics that are cogent as we look at stocks get pummeled today. The song was Anticipation. Anticipation is making me late, is keeping me waiting. See, that's exactly what you must avoid in this market. You can't be late. You can't be waiting. You must anticipate. And yes, some days like today, buy. But when it is a bloodbath like today, with tech just getting wrecked, including some of our favorites, you forget the need to anticipate and to act in a positive way. I know you want to keep your bat on your shoulder. I don't blame you one bit. But see, what we're seeing right now is capitulation. Analysts are capitulating in stocks every day. And we can't just succumb to the selling. Now, we have been exiting positions bought a long, long time ago. And we sold most of these at very high levels when these same towel throwers were champions of the very stocks that are now down 40, 50, maybe even 60%. We can say that they are a fraction of what they have been selling for, not just because a recession may be coming, but also because they fear the Fed has to take action, aggressive action, which reduces the value of the earnings stream of, say, let's use the example of NVIDIA out 3 or 4 years. I come back and say that NVIDIA is not some fly-by-night SPAC, some sizzle but no stake IPO. Remember our mantra? It's from November's meeting. We want the stocks of profitable companies that make things or do stuff, that sell at a reasonable valuation and return capital to shareholders. We feel that the whole notion of a second-half slowdown that will cut these stocks in half again, which is what the analysts are all saying now, is too negative. We say that because the primary cause of weakness here is the Fed, and it's tightening, taking the money away. But the primary cause of buying is that when inflation is taken care of, it's too late to buy. You cannot have the anticipation make you to be late. You can't keep waiting, because the moment the Fed stops raising rates because inflation is tamer is the moment that it's too late to buy, darn it. Days like today are days that you buy because the stocks are in free fall. These are the days we think to buy back stock that we sold at the highs when analysts were championing these same stocks, because that's when the thesis noxious downgrade should have come. The most important question to ask is not, are we too early to buy more of the stock of NVIDIA down 48% from its high with the 28 PE, with analysts speculating that its gaming, industrial, Internet of Things, Ethereum, and high-performance data center businesses are all bad now? The question is, are we too late? If we get the last Fed hike for now, it's not the slowdown, it's the anticipation of the slowdown caused by the Fed to tame inflation. And it's our job to figure out how far we are along in the inflationary pressures that make the Fed tamp down the economy and then thus, well, make NVIDIA uninvestable. How bad is inflation? See, it's so tough because if inflation's going to moderate, well, the day that it moderates is already too late. You'll have missed the NVIDIA bottom. It's just so painful to watch it now. I think all of us are getting our inflation gut punches at this moment. Mine came just yesterday. It was a shocker from my Summit Elks Club. By the way, it's the best Elks Club in the land. You get your email and you're looking. It was under the subject line, beer price increase coming soon. Came in a most unwelcome missive, and I quote, "We are sad to report that due to the increasing cost to operate our lodge, your lodge officers are recommending an increase in the price of all domestic and imported bottled beer." Then the real roundhouse. Domestic bottled beer is currently $2 per bottle, and the recommendation is to increase it to $3 per bottle. Imported bottled beer is currently $3 per bottle, and the recommendation is to increase it to $4 per bottle. I think I may have to attend that July 20th meeting where these increases will be on the agenda, if only to argue vociferously that the best Constellation brands, Modelo, Corona, and Pacifica, be labeled domestic, because Constellation is based in Victor, New York, right outside of Rochester. Inflation is the enemy here, not the lower earnings. Inflation, make no mistake about it. Whether it be the consumer price index on Wednesday, the producer price index on Thursday, or the retail sales number Friday. Now, all these numbers are going to be bad. They'll be red hot, except for in retail. And retail will have a component of inflation. But we must always ask if they will be the last of the bad numbers. Do we really think, for example, that the Elks is an early adopter of beer increases? The most fundamental, of course, of all drinks, especially during a recession when more is consumed than during good times? Do we think that that's a bad call, considering that we went from $7 to $8 at Bar San Miguel for the same beer 6 months ago? And yes, Lisa and I did sell the bar, but not because of inflation. We did it because of Phosphoro, my wife's own mezcal, because it is against federal law to own a liquor company and a tavern in this country. Go figure. It's called the Tide House Rules, right after Prohibition ended. So the question I ask myself every day is, could this be the final round of price increases? Because if we think it is, then we must be full-bore equities despite what the analysts say about a given quarter. You cannot wait until the Fed wins the war. They're going to win. This is not my first tightening circus. It's no rodeo. People say rodeo. It's a circus. And I know that you have to buy stocks aggressively if you think that we are further along than most others do. I can tell you that there is no all-clear buy signal. No one says, okay, NVIDIA's fallen 60%. Now it's time. No, they will still be downgrading. But if the Fed moves at the end of July and it's a 0.75% increase, which is what I want 100, but I'm not going to get that. Then the rate of Fed funds, there'll be plenty of people who buy, betting that is the last of the increases. You always have to anticipate that buying and put money to work right into the expected decline of the stock market, one that could be exacerbated by the anemic earnings and tepid forecasts. That's exactly what I think is happening right now. We just haven't had all the companies report yet. I mean, for instance, Micron at 58. They reported it was at 53. Now it's at 5. You can't wait. Now, you might ask, how can you buy stocks going into recession? To which I would say we are already in that recession. It's just a different kind of one that we aren't used to. This is a glut recession, an over-ordering recession, a hard-to-forecast double-order recession, where it seems that every enterprise asks for too much product, whether it be from China or U.S. distributors, and is now stuck with it, as sure as Walmart and Target were then they last reported. Can you imagine how much imported stuff is on the way? At least, except now it is stuff we do not need. If you wait for the big layoffs to start, you will most certainly miss the bottom, especially because the layoffs will be led by where the biggest glut will be. The engineers working for entrepreneurs and the established tech companies. It will be the Oracles and the Amazons and the Meta platforms and the fintechs. The worst will be from companies that couldn't come public and fail to raise capital needed to survive. That's where the layoffs are going to come. You won't see them initially. That's why I am not monitoring labor like everybody else, including the strong number from last Friday, which didn't bother me. As much as I am examining used flatbed Fords, Toll Brothers homes, resale value of Lennar's Best, gasoline and natural gas for export or air conditioning. I want to watch domestic food and consumer packaged goods prices, as those are the areas that are most pernicious to you, to me. I care more about Cisco, the SYY kind, raising the price of a block of cream cheese from $175 to $200 come August. That block, of course, is for the restaurateur. I care more because the real issue is, when will people run out of their pandemic savings? When will they be so hurt by gasoline prices and then say no to the increases? The consumer, the retailer, even Cisco right now know that there's no end in sight to the price increases. That keeps me from saying, okay, we're certainly not late. See, I worry more about being late than early. I monitor real estate loans, commercial loans, commercial consumer credit loans. And as of Friday, they're all still pointing upwards. That's great for the banks, by the way, reporting this week, but a persistent thorn in the Fed's side. Until there is some sign or price stabilization, an indication maybe that Clorox can't put in the third round of price hikes without a private label retaliation. That's going on right now. We won't be safe from Fed fund increases that make the asset class we care about suspect. And there's no sign that we are there yet. But when we are, when the gluts hit everything from the aisles of Home Depot to the caverns of Costco, which, by the way, Craig Jelinek, when I interviewed this morning, the CEO seemed to indicate is happening, and then prices will come down, the Fed will have won. And we better be almost fully, if not fully invested in the right kind of stocks that aren't as defensive unless they have good yield. For the record, I think the Fed lands the plane without too much damage. Remember that now tired metaphor? If only because the last of fatigue will be wages and the usual spike in unemployment will not occur and can't be waited for, even though all the last recessions, that's been what I looked at. So how about our stocks? We're doing something I haven't done since the early 90s. We're overweighting the oils, buying Halliburton for growth and drilling, Coterra for its amazing natural gas properties, perfect for the shortage in Europe, Devon for growth, great dividend, Pioneer for its bountiful yield, used to be the fastest grower, can be if it wants to, highest in the S&P their yield, and Chevron for its leadership. Our thinking goes like this. If we are going to own stocks, I mean, not trade them, we need a hedge. And the only thing that could really spike and derail the averages, particularly the sensitive tech stocks, is oil and gas. We're using these stocks as a hedge. No, they're not working today. I'm quite conscious of that, but we're using them as a hedge today because they should help us more than cash, especially because 3 of the 5 have very good yields. It's hard to imagine techs reacting to bonds. They were never cyclic. Now they are. And the multiples are coming down hard because of demand, whether it be true or not. Just the analysts saying it's bad. Our techs are uniquely targeted to the enterprise, not the consumer, which means either you think the strength is secular, as I do, or you are just waiting for the other shoe to drop, as the analysts seem to be. The fact that they are all trading together is part of the ETFization that I always bray about to no avail. Witness that while AMD has almost no PC exposure, nor does NVIDIA, they have gaming and are therefore viewed negatively as post-pandemic plays, doesn't matter. When they aren't, people will buy them. We are long and staying long. Marvell Tech is easier. It's almost 100% enterprise for 5G and high-performance computing. We bought some last week. Why is it going down? Well, there's a relatively new thesis that the whole internet is slowing down. High-performance computing will slow with it. This despite no evidence of that kind of slowdown, except a few anecdotal examples. Where we've gotten in trouble is with the late buy of Qualcomm, betting on a reopening of its biggest market, China, which didn't happen, and belief that its hard pivot to auto chips, particularly for electric vehicles, would drive the stock higher. Hasn't happened yet. Plus, it is low multiple, but in this market, low multiple tends to lead to even lower multiples before a bottom, as we saw with Micron that I just called out last week. And that's what happens when they get so cheap. You have to act. Think about it. Micron reported an okay number and really cut its forecast, and the stock is up. That may be, if inflation gets under control, the template. Some disappointments linger, buoyed by the yield. I mean, that's the case with Cisco, the CSCO kind. Can we really sell it now down at the low end of its range with a 3% yield after the risk is taken out? Frankly, I'd rather buy it. Then some aren't disappointments at all, like Salesforce.com with a blowout quarter, huge cash position, and Dreamforce, where it does most of its new business dead right ahead of us. After 2 years of COVID-related suppression, Salesforce is right, not wrong. Or Alphabet, which is doing so well that the only thing that can stop them is the federal government, with legislation in Congress that would not allow them to offer certain kinds of advertising products that customers love for the return on investment. Don't worry, we're monitoring that. We have had to go light on the industrials because they are a disaster area, not when it comes to earnings, but when it comes to the market and people anticipating bad. They're brought down by everything from raw cost of the strong dollar to China's COVID strategy, dubious at best, to the war in Ukraine. Just too many whammies. We have held on to Honeywell for ages, upgraded today. It's the safe way to play aerospace, given the pathetic weakness that is Boeing. I don't miss that one, by the way. because Dave Calhoun, the CEO, seems very disengaged. His solution to all their problems: move the headquarters to Washington, where the lobbyists are, not Washington, the state where the planes are made. Linde, our industrial gas, is regretful in that we chose to hold a lot of it through a spike up. So now we feel obligated to hold it after collapse and perhaps buy. It's the culprit, the war in Ukraine. In retrospect, it's one of several we own, the others being Walmart, Wynn, and Bausch, that we are what I call hung on. Linde is the only secular growth industrial, and Honeywell fit the description of companies that make things and do stuff that sell at reasonable multiples and return capital to shareholders and buybacks and dividend, of course, profitable. We scaled back financials to just Morgan Stanley and Wells Fargo because you're not supposed to own these stocks in a recession. Now, I think when they report, they will both have different things to say. Morgan Stanley on the weakness in trading and Wells Fargo on the weakness in mortgage lending. But the buybacks of Morgan Stanley and the dividend of Wells Fargo make me want to stay the course. We've been buying Morgan Stanley on the way down. Their multiples are insanely low, and their net interest margins are as high as they've been ever since the Fed decided to raise the funds rate to make it so that they could, well, let's just say that they could liquefy after a period where the rates were down a great deal. I mentioned Walmart as a stock that we held on to, even as it went to the 150s. That was a mistake. It was a mistake to think that it has the qualities of a dollar store, not a department store. It's the first time I've ever seen Walmart whooped as badly as it was, and its weakness directly correlated with Chinese imports stuck in the ocean. They should have hired their own fleet, a la Costco. Wynn, just another casualty of China's COVID vows. Now it's closed for the week. Now, I didn't see the aversion of vaccines coming. It was irrational. I think it will end up being a source of funds if we need the cash. It's a very small position. I didn't like the week-long shutdown that they announced in Macau. Finally, there is the high-graded defensive stocks, starting with two stocks at all-time highs, Humana and Lilly. I had Humana on Mad Money recently. The CEO told a tale where COVID was now less hospitalized than flu. And its expense control and better advertising turned the corner of this queue. Should be the first of many. Notice I'm going over the stocks before we get to the stocks. We're going over the ones that are not going to be in the Q&As. Lilly is all about new drugs. First, a drug that helps both diabetics and those who want to lose weight, especially if they take medicines to put weight on them. Let's not forget that they have the best brain franchise. And I know from my role as the chief spokesperson for the Migraine Foundation that they are the closest to staving off dementia, which would give them the biggest drug in history. Oh, you got to like Procter & Gamble here for its brand power and its ingenuity. Procter is, here's a typical on a really ugly day, and Procter is up nicely. There's been no trade down whatsoever from Procter, which is incredible. It's highly unusual. After all the price hikes, I am betting that while the dollar will hurt them, they'll be much better off when it comes to supply chain woes. They're too powerful. They should balance out, and PG should report an upside surprise, ex-currency, because of excellent organic growth. And finally, before we get to the other Q&A, there's to the Q&A that has other questions involving stocks I haven't mentioned. There's Constellation, which reported a terrific quarter. Promptly fell for no reason and is now above the report. When I interviewed Bill Newlands, the CEO, he was as confident as I can recall in the change in classes of stock that eliminates the SANS special qualities. In other words, the A and B stock will make it so buybacks will be far more effective and a possible takeout more realistic, even as I doubt this new antitrust department would allow it. A round trip of the Elks memo to Constellation is a nice way to lead into the questions that touch on the rest of your portfolio. Suffice it to say that I think we are set up well for what I believe will be a dramatically slower growth because of gluts, not firings. So let's now bring in my partner, Jeff Marks, to tackle your most burning questions. And Jeff knows. Jeff, how are you?
Doing good. I'm glad to be back. I missed last month.
Yes, you did.
I was under the weather, but
Right.
It's good to be back. You know, it's the first call I've missed in 4 or 5 years.
Well,
so excited to be back.
Yeah, well, look, I think that one of the things that you and I both know, and you heard what I was saying, is that I would love to wait like everybody else to the bottom, but we never know where the bottom is.
Oh, sure.
So we've been keeping that in mind with a lot of our questions and with my preamble, my speech, because I think that it can be a 2-day move. It could be a 2-day move. And Peter Lynch, great money manager from Magellan, wrote an article where he said that over a year, there's 2 or 3 days where all the percentage gains occur. And if you wait, those days are the days where the people are trying to catch up to what we're doing ahead of time. So let's go to your questions. Let's kick it off with Corbin, who's asking, should we be nibbling at growth stocks? Like, I love this question. Like Meta Platforms, Apple, and Microsoft, or wait until more pain is in the market? Okay. Now let's take these one at a time. I was on with Mark Zuckerberg about Meta.
You were in the Meta.
I was in the Meta. He designed my avatar, and the betting is that it's going to fail. I don't think that's good to bet against Mark Zuckerberg. In the same way that 6 months ago we were told that TikTok could never be assailed by Reels. Now Reels is passing TikTok. Is he spending too much money on it? I judge that Meta down here today is a buy from where we sold.
Yeah, I agree. I think that with the multiple where it trades today, low
12.
teens. I know there was a downgrade today from Needham.
And she's influential, Lord Martin.
Sure. But look, I think down here, already down 50% or so for the year. I think, with the multiple that it is, I think there's a lot of risk already priced into the stock. And, this is a company you can own for the long term. So, of course, nibbling, could we see more pain in the market? Of course.
Right. But 384 down to 154, that Lord Martin downgrade, is that early?
No, it's not early.
What are you betting on that? It goes to 100? Down 50?
Yeah, I mean, look, that would, I think that's a little too much of that'd be a lot of pain, but I think the multiple is there. I mean, they do buy back stock as well.
Oh, they bought back a ton of stock.
And on the metaverse investment, yes, they have to spend a lot, but it's needed because we've seen with the challenges they're facing with Apple and privacy, they need their own operating system.
Right.
And this is going to be their world where, for better or for worse, they can control it.
Right. And it's $43 billion in cash, so they can spend it. They are having, when I speak to the company, they're making it very clear that they over hired.
Mm-hmm.
And things are tougher, but they are an inventive company. And I think if people try the metaverse, I think they'll be shocked. It's so good. Now, Apple. I think you and I are both concerned that it's not going to be a strong quarter, Apple, and that one maybe is a little bit more of a wait and see.
Yeah, I think so. We have it at 2. Remember, we made a pretty nice sale of it a couple months ago. It ballooned to 6% of the portfolio, which is where really anytime for us, we own 33 stocks. Whenever something gets too big, we like to right size it because we don't want to be too beholden to one name. It's just a portfolio management move. But yeah, I definitely want to see the quarter, definitely want to see guidance. We know they took some pain from the China lockdowns. There are some new products that we're looking forward to in the future, whether it's VR, but that's a ways away, I would say.
All right. And then Microsoft, I would buy 264. We have a lot. The stock is down. This is from, Corbin. I would buy it 349 down to 264. Big buyback, 27 times earnings, pristine balance sheet. Probably, as you're still doing well, as far as I can tell from my check-ins. Stock, the low has been 241. We bought some at a really nice price.
Yeah, and look, I think again with the market down as it is, you should be looking for these high quality, profitable, free cash flow generating tech companies. These are 3 great examples of one. So of course, nibble, we could see more pain, but that's why you don't put on a full amount right away.
Right. Okay,
you can dollar cost average.
Right. So I say yes to Meta platforms. Okay, Apple hold until the quarter.
Yeah, let's at least see it first.
Yeah, and I think that's fair.
Yeah.
And then Mr. Softy, as I used to call Microsoft, right here. All right.
So these are some of the growth names, Jim. What about the oil names in the portfolio?
Well, the best oil growth name is kind of holding itself back right now, but I do want to do some buying into the weakness here. And of those stocks that I see that are down the most, that have a great yield, 14%, is Pioneer. Now, Pioneer used to be the greatest growth. Doesn't matter. They can grow at 5%. They're going to make a fortune. 6 times earnings, highest yielding stock in the S&P. That's the one that I'd like to pick up and tell people today because it's down 4. We've waited for oil to come down. The price of oil is still north of 100. I know the company. I'm speaking to the company. They are committed to having the highest yield in the S&P, no matter what. I think that's what you buy on a day like today, unless if you hadn't bought all the tech stocks that we did.
Mm-hmm. Yeah, I think there's some a little bit of a misconception that because the stocks are down bad, that these companies aren't doing well. But at $100 on West Texas Intermediate, they are still printing cash, and we know a lot of that cash is getting returned back to shareholders. Pioneer, their 75% of the post-base dividend free cash flow gets returned back to shareholders.
And when I make it clear, you could argue, well, listen, Jim, that question from Corbin is about tech, but I was looking for something to buy, and the tech stocks, frankly, are not down enough, except for NVIDIA and AMD. But I talked about them endlessly today on the show, so we're frozen.
Yeah, so can't do there. Looking at NVIDIA, though, I noticed Piper took down numbers today, but look, I think we're 150. It's still down. It's down from when they reported last, even though they cut. We'll probably see another cut the next time. Yeah, sure, numbers are too high, but this is just such a high quality secular growth company. Data center still doing extremely well.
I was talking to Faber about it, and Faber was saying, well, Jim, it's still a $300 billion company. It was a $500 billion company. But you know what? Do I think it can go back to being a $150 billion company like it was in 2020? No, I just don't think so. All right, next up you.
So next up, we have Monica in Colorado who asks, what are our thoughts on Danaher for the long term? This is one we still like very much for the long term. I think the key thing to remember here, 75% of his business is recurring revenue stream. So it's a lot of repeatable business. 90% of it is in non-cyclical areas. So it's life sciences, diagnostics, and water. So why is that important? It doesn't need a 5% GDP number to grow its business because it has that secular exposure. Fantastic management. They're always looking for ways to bring out value. A lot of it's through M&A. We haven't had M&A in quite some time, but they have plenty of cash.
Amazing steal from GE because GE's balance sheet was so hurt in their life sciences, which I don't want to say they stole it. That's wrong because
it was the crown jewel. It was the crown jewel of GE.
But of course, Larry Culp had
aerospace too. It was a great business.
So I mean, I would emphasize to people, I think this stock is done going down. It's been acting incredibly well, and it's never cheap. You get these incredible growth stocks at 25, 26 times earnings. You're not going to get them at 20. I mean, people don't understand that. That's why you have to act ahead of the bottom. Ahead. The bottom will last 30 seconds.
Yeah, it's interesting today, too, on a day where there are some concerns about China lockdowns. Danaher does have a big China exposure, but it's holding in there. So I think that's very positive. A very defensive healthcare name for those recurring revenues for its end markets.
Now, Jeff picked the alternates, so I see that you ding me with Bausch Health. All right, now let's talk about what happened. I want everyone to understand the process. And I read the mentions column in my Twitter account. I was hoping that they would talk about the zucchinis. No, they talk about this. Joe Papa I've known for years. I've known Joe Papa for a dozen years. He's the CEO of this. He's the head of this complex. He came on the show a few years ago and he said, listen, I'm going to clean up Bausch. I'm going to do this. I'm going to get the debt changed. I'm going to bring out new drugs and do all this. He did everything he said and more. So then he comes back on the show and he said, Jim, I've done everything you said and more. I did everything. And remember, you said that if I do it, then you would think the stock's attractive. And Jeff, what happened is he did do everything. And he did plan to break things up. But he sold the most important crown jewel at a price that made it so that the rest of the company seemed valued at nothing. And then we've got this less than nothing. We got the darn lawsuit, the Xifaxan lawsuit that went ahead, that is going ahead, that I was hoping to be settled. And that's how a stock gets cut like this.
Yeah, the IPO, very unfortunate timing. The whole IPO market frozen over. We should point out that Xifaxan, that litigation is expected. We should get some news late July, maybe early August. I think that's a big reason why we have held off from buying or selling, because it's really a coin flip at this point.
But it's
at first it wasn't.
But that's elusive, because it was really 2 times earnings that people be buying that count. People were worried that the earnings would drop dramatically because of the Xifaxan.
And they got to get the debt down,
Right.
of course.
Right. And they do have a piece of debt due 2025. So we downgraded this to a 4. We very rarely do 4s, but it's because it's too uncertain. We keep checking it out. I've made a million calls in this thing, and all I can tell you is I feel like an idiot, but this is life. This is what happens. We're portfolio managers. We're not the only one who bought this. Carl Icahn bought it all the way down. Carl Icahn's a genius. I may be an idiot, and he may be a genius, but we bought the same stuff. So we're watching and waiting.
I was going to say, we should point out John Paulson, chairman of Bausch Health now. He replaced Papa. And we have a couple Icahn guys from Icahn Enterprises on the board of Bausch and Loeb. And look, they're looking at it too. They're not happy, I'm sure.
No, they're not.
Too hard to speculate what exactly their plan is. But the plan is, I'm sure, to bring out value and unlock value. So
right. And I mean, is Joe going to go? I don't know. I mean, Bausch and Loeb is worth more. The sub's worth more than the parent, which is an oddity that usually is rectified by the parent getting higher, not the sub going lower. You're up, my friend.
All right, so we're going to go down south to Jerome in Louisiana, who asks, I own shares of Costco and would like to buy more here. Where is it to buy? Well, we heard from the CEO this morning.
Craig Jelinek.
Yeah, it was
very rare that he's on.
I thought he told a great story. It sounds like business was doing quite well. We did have the monthly sales report number come out. Thursday, we did a write-up on it Friday.
His note was fantastic after that. I urge you to read it.
Thank you. Look, the membership price hike, he seemed that it wasn't, I'm feeling the same way.
The mood of the country did not allow it.
Right. He doesn't want to be as seen as someone who is further putting stress on the consumer, even though they're really the saviors because they have the lowest prices. But the special cash dividend, I thought, he said he
did not seem to be against that.
Yeah, right. I think the timing is right. They have plenty of cash on the balance sheet. But we don't really own Costco for the dividend per se. It's that it pays regularly. But a special cash dividend, whether it's $9, $10 per share, that obviously would boost capital returns, makes it more meaningful.
I thought he was being sly. Well, he's not a sly man. He's a straightforward guy. But I thought that Craig did not deny that there could be a special dividend.
So to answer Jerome's question, where would you buy? Down 0.5% today. It's around $500 per share.
It just had a big move up.
Yeah, I like it on days where kind of things get crazy because in a crazy world, Costco is so dependable. That's how I always think about it.
38 times earnings is not cheap. Highest multiple in the retail business, but because it's not really the retail business, it's in the membership business. I say this: it's at 498. I'm looking at where it would still hold the level. I think 480s. All right.
Yeah, and as always,
but we have a nice
start
position.
Small. Oh, sure, for us. But as always, start small. That's kind of how we always play it, and you can scale into it slowly over time.
Okay, so Robert K. in New York says, with so many companies experiencing dramatic valuation drops, very true. Why aren't we seeing the merger and acquisition activity picking up? Seems like a right moment to consolidate so a company can pick up some growth on the cheap. Okay.
Great question.
Yes, a fantastic question. I've spent a lot of time on this question because I like it so much. And I fortunately have a lot of sources, both within the government and within the legal community. People are very afraid, not of the FTC. They're afraid of Jonathan Kanter, who is the head of antitrust for justice. Now, Jonathan Kanter worked at Paul Weiss, which is my firm, for 34 years. He's a very rigorous thinker. I've read his speeches. This man is not going to allow any merger that could hurt consumers, or any merger that could hurt people who want to work in a field. Notice he's blocking Random House Simon Schuster. Why? Because he thinks that therefore there'll be fewer chances for writers to be able to get book contracts. So I think that the lawyers and the bankers have all said, whoa, we don't want you to just go out there and buy anything that consolidates, because that's going to get a consolidation merger is going to get blocked by justice. And that's why we haven't seen the deals that I think all of us would have expected.
So how about this? What if a company were to acquire another one in the portfolio? Who would you handicap? I think two that are likely: Danaher, that we talked about earlier.
Danaher as an acquirer.
As an acquirer.
Yes.
Of course. And Honeywell. They've always waited. They've always said valuations are too high. Valuations are too high. Well, we've seen multiples come down.
Wait, you read the Honeywell upgrade today. There was nothing in it, which meant to me that there's something going on.
Yeah,
It was a stupid upgrade. They didn't say a single thing that mattered.
It was, we like their the end markets, aerospace, oil and gas, high quality name, of course.
Right.
I mean, look, if there is one industrial to own, I think you do want to be in a Honeywell because it has the balance sheet, it has those end markets. But look, it's a great question. We've seen a real slowdown in deals.
Well, I tell you, it's antitrust. No, look, I've done enough work on this thing. The guys who need to do it, Cisco needs to do an acquisition for ever's sake. I think Salesforce, I don't know. I think he feels like the last few, it's Mark Benioff.
But he's focusing on margins too.
All right.
That's important. That's what shareholders want.
I think Qualcomm, conceivably, to get more into the auto business.
Sure.
They want to get that to be more than 25%.
Sure.
Cristiano Manas told me over and over again, he wants industrial to be 40. So I think that's a possibility. Can't do any bank deals. NVIDIA, I don't know. Marvell Tech, he's done all the deals he wants.
They tried with ARM.
They tried, I know. Google can't because Justice be all over them. Hal can't, Justice be all over them. Disney. Maybe Disney has to do something totally off. Maybe you have to buy a Unity. Maybe you have to buy an EA. Now, we know that Microsoft's, the scrutiny on the Activision deal is pretty big. But I think Disney needs to do something. And they got to clean up that damn balance sheet. I was hoping that when you saw Thor, that you would have, now you got a bunch of very big Marvel movies.
Yes.
And they should generate bottom line revenue. But I don't know.
Yeah, they all do well. I mean, every single one that's in that the Marvel Cinematic Universe, they're cash machines, right? They print money off them, but no one seems to care right now.
Not now.
Long term, I think.
But that's an example. They don't care. Not now. There'll be 3 days where it goes to 120. It'll be up 6 the first day, and you'll say, "Oh, I can't touch this." Then it'll be up another 6 the second day, and then you'll say, "I missed it," and then it's at 120. All right, now.
All right.
Go ahead.
Yep. So next up, we have Steven in Florida who asks, can you explain the Johnson & Johnson breakup? When will it occur? What is your opinion of the two companies it will become? So just a reminder, J&J, it's separating its consumer health business from its pharma and medical device business. The deal was announced, not the deal, but the separation was announced November 2021. They said it's going to take a while, 18 to 24 months. So,
but we will know more about the financials at the end of this year.
Oh, absolutely. As we move closer, but we still probably have about a year until it's actually completed. We do have the CEO for the consumer health business that has been announced, but consumer health, that's going to be more of the defensive, slow-growing, investment-grade balance sheet, competitive dividend, like a Clorox, like a Procter, Colgate. They should be bolt-on acquisition heavy. We just talked about M&As if they allow it. Just kind of moving into some higher growth opportunities. Beauty is one, and then of course J&J has one of the best pharma businesses, which works so well in this environment because it's defensive growth. We like the idea that they're going to become more focused. They can better allocate capital towards their needs and the consumers' needs. So I like the deal. I like J&J.
Oh, I love it.
Sheet.
And great balance. Yeah, AAA balance sheet, one of the few in the business. Not worried about the talc. I think they're handling it well. I will miss Gorski. I miss Gorski as it is now. He was very good. Just a guy who wants superior returns. All right. When should investors reasonably expect Disney to reinstate a dividend? Okay, ask Robert in Florida. Robert's actually the right question. They want to so badly. When I speak to that organization, it is very clear that their priority is to spend on parks. They want to do that. But they want to get that balance sheet so they can bring back the dividend. So that is another signal. Again, I know this stock is hated. It is one of the best franchises I have ever seen. So as far as I'm concerned, when I look at Disney and I think about Disney, oh my God, so Thor comes out, I'm talking to Lisa, and I say, oh, you know what? Big movie. We'll come in on Monday. People will relate the movie and they'll say, hey, listen, they've got these franchises make a lot of money. What happens? It opens down $2.
Yeah, I guess people kind of believe those are already, in the numbers already because it's foreshadowed.
That's nonsense.
But the parks business, yes, look, I think Disney people are selling it too because they're worried about the consumer in a recession. Maybe they're less.
Oh, well, try getting into one of the theme parks.
Exactly.
Yeah, and gasoline. And give me a break.
And international travelers really haven't fully come into the U.S. just to various restrictions and reasons like that. So the parks are still sold out.
Right. I'm begging them to build a new park. I wanted initially in Texas, but because of there's trying to avoid any political stuff, okay? 'Cause it's so hard. By the way, I was talking to Bowers Espys, our trustee, about the importance of trying to not shoehorn politics. But here you go. I mean, Disney's descent started with that DeSantis dust up. So we have to watch it. They can't put up a theme park in Texas because they'll be afraid of the same thing. So, I mean, it's become a political issue. I will be candid. It's not my strength because I'm a stock guy. And I don't think you want to sit here and listen to my rant or favoritism for DeSantis. That's not what we do. We have to keep an eye on politics.
Yep.
But, I mean, I was watching the possibility of having a gun company on CNBC that is valued at an incredibly low price. And just by even having them on Mad Money, I was concerned that people would think that I am advocating that you have to consider owning a gun stock. So we have to just stay. I don't want Disney to be political. I never thought it'd be political, but it is. All right. You want to go to
Yep. I'll go to the next one. Let's go to Nirav. I apologize if I mispronounced that, in New Jersey, who asks, what are the best defensive healthcare stocks to buy right now? Defensive healthcare, I think Humana, that's probably the top on our list. I know we just recently trimmed. It's only because that was out of discipline with the stock making a new high, but it's...
And by the way, can you understand that we did that because when we made those tech sales at new highs, they were great. But when we didn't sell Walmart, we were foolish. And we were not going to do a Walmart here.
Yeah, we did not want to be greedy, absolutely. But why is it so defensive? It is, well, it's 100% domestic business, so you don't have to deal with the impact of currency or the war in Ukraine or lockdowns in China. Interest rates really don't impact the business at all. And it trades at a reasonable valuation. That's what we like to see, profitable. So that's defensive. Also, pharma is defensive too. AbbVie, you got a big div. J&J, great growth. Great growth plus the balance sheet. Lilly is the best growth.
Lilly's best growth. But did get to that because I did some work on Lilly apropos of this meeting. But aren't you surprised that AbbVie continues to go higher? It's not a great company.
They do have a big challenge ahead of them with Humira, and I think that's why we have favored J&J instead. Why we favored Eli Lilly. I mean, it's been one of the biggest names in our portfolio where AbbVie was more of a seller. Again, I think it's kind of those defensive characteristics. It has a huge dividend yield. The market wants yield, safe yield.
And maybe they'll do something. There's going to be a change at the top there too. Maybe they'll do something with Allergan beyond the small Botox work that they've done. They've done very little with their migraine drug, even though Biohaven Pharma got bought for a ton of money with a competitor from Pfizer, because Pfizer recognizes this as a $5 billion opportunity. I point out that I met with some people at the at a new institute, and it's not public yet, where we were talking about brain, and it really is Lilly. And Lilly's not going to come out and say that they've mapped the brain that well, but Lilly is the one that has got the best plaque remover in the brain.
And they've totally de-risked their Alzheimer's pipeline from the stock. I mean, now it's really trading on that blockbuster diabetes and obesity drug, tirzepatide, but Alzheimer's, that could be a 2023 story. So I think a lot of the move today isn't about what they are. What it's de-risked is what I should say. Where if there is good news, there will be more upside from.
Right. I mean, like I said, I do this thing. I this CFO council for the network, and I sat next to the CFO of Lilly, who's quite smart. And it was, I mean, of course I'm asking about it. I mean, because that's what I do. I mean, if you don't ask, okay, if you don't ask Ned Siegel from Twitter what's going on, these people can't answer, but you always want to know. Yeah. And she gave me the Heisman. Just absolutely nothing. Absolutely nothing. All right. Here's one from Winston B. Wish I knew where Winston B's from. I have owned some NVIDIA shares for quite a while because of the market conditions we're all experiencing. I find it difficult to know if this is a good time to buy some more shares or sell what I've remained. What do you think? Now, I don't want you to sell it. When it was down today, I was talking about it on air as being, really interesting opportunity. And what was interesting was it just drives me crazy. Okay, so Laura Martin, the analyst who downgraded, she gets tremendous kudos on downgrading. 346. The stock was at 346. She downgrades it at 154. Is that good work? I mean, if you downgrade at 154, you must think it's going to 100. I don't think it's 100. Do you think it does?
NVIDIA, I don't think it does. I don't. I think because it is just such a long-term great growth story, the buyers will come back. Unless, look, of course, something could happen, if maybe we do. Look, I don't think so.
Right.
I don't think so. I think it's too great of a company.
I'm going to tell Winston B to start small and buy her. All right.
Yeah. Look, that's what we did after their last quarter.
Well, we sold. I want to buy. Now, today I did come to you. I said, listen, this is ridiculous. I think we should buy. But, there I was chatting about it with Faber and Carl. That's just neutral. I mean, one of the most frustrating things since we started this in 2005 is that the best idea may have been to buy NVIDIA down 7. So I said it on air. But I don't want to make it so the club doesn't get better. The club should get better. People are paying for the club. So my advice is that NVIDIA start small.
All right. Next question. We have Keith in Wisconsin who asks, can you please talk more about high grading a portfolio and how to know if you should do it? This is a great question.
Love this question.
This is something we've been going over for months and months and months now. Essentially, what we're doing is we're selling the stocks that are just not right for this environment, whether it's they don't have great profits, they don't have a great balance sheet, don't return cash to shareholders, just not right for the current moment when we know the Fed. You can
say, well, then why'd you embellish? And I explained the mistake I made.
And that was a special situation also where there was a breakup catalyst.
I know, but it did not fit the mantra. So I go outside the mantra, thinking I got a special sit, and I get my head handed.
Yeah, and look, I think there were plenty of sales that worked in the high grading process, whether it was getting rid of PayPal. It wasn't too late to sell PayPal. It wasn't too late to sell American Eagle Outfitters. Wynn Resorts, we've been trimming back. I know today it's down heavily, but it's very small. And then what have we been buying? So you take that cash and pretty much on a one-for-one basis, you're going to buy the high quality companies, the industry leaders, the market share gainers. We've been doing Procter, Constellation Brands, Humana was in there. Plenty more on the list. Danaher, I would call a high grading scenario as well. And you do that because when the market gets very volatile and everything is down, the market's down 20%, that's going to be the opportunity to really boost your portfolio, get it in the high quality names that you're going to want to own for the next 3 to 5 years.
Right. And the mistake, this is a teaching product. The mistake that people make is they sell their winners to fund their losers. So what you'll be doing is you'll be selling Lilly, great company, and buying, let's use the example of PayPal when we owned it. Mm-hmm. That's classic bad portfolio management. You always sell your losers, not your winners, unless the losers have a specific thesis that you think is worth owning for. All right, so here's Steve R., who writes, when do you think it would be a good time to get back in Amazon? I sold it a lot higher than it is now. Do you think it's going lower, Biden? That's a really good question. Now, Amazon completely overordered. I mean, completely. It was sinful how much they put, how many people they hired. And they recognized that. It was for, it's a moment in time where you're getting Amazon very close to its low, down from 188, down 32% for the year. We know the quarter isn't perfect. We do know from Slipsky, whom I interviewed,
who runs Amazon Web Services.
Amazon Web Services is doing fantastic. Yep. We have Amazon Prime. That will not work for the stock this year. I know it will not work for the stock. It's kind of upsetting because, of course, you want it to work. But I think if you bought some right here and then waited, I think it's a good idea.
Yeah, and look, it's
tempted. You tempted?
I am tempted. There are a couple things a little nervous about. We know fuel's been a problem for them, and overcapacity. It's going to take a couple quarters. Overstaffing, I think they probably figured out pretty quickly. Right. We're seeing that now, but I'm definitely tempted. Remember, we did trim some when they announced the stock split.
I'm begging them to buy that back, but I think our discipline says that you can't buy them all back. But I am going to argue at 100 that we're going to buy the Amazon back that we sold.
I think so. Yeah, I think so. I'm itching to buy it. Very tempting.
I was talking about the idea with some of the great people that we work with, and we just have an unbelievable team. That we ought to have a camera in there in the morning, and just just hash it back and forth and see what happened. Margaret DeLuna, who came over with me from another company, Regina Gilgan. We're trying to figure out whether it's right. We got that new set too. But I mean, look, like this morning, I said, hey, we need to buy, when you said that if one of the oils is free, we buy one of the oils. And so we went over it, and I came up with, I said, Pioneer, we got to wait, because you had said, wait, we can't do it, we can't do it. All the way down. Clash, which is what it really happens. See, you have to understand. You see these guys on there, and they're like, oh, we talked about it. We bought some Pioneer. It's not like that at all. You come in the morning, and you look at Pioneer, you say, darn it, we got to buy more. But then I got a guy who's got another idea. Or maybe doesn't think Pioneer's right. That's what it's like. By the way, it's one of the reasons why I want you to, even though I see the ads, if you could ever talk it over with a person, and you don't have to, look, you can still go electronic, but you should be telling someone, listen, I'm thinking of buying X. Because the number of people who've been blown out, I mean, I talked to someone, and they know who it is, so I don't want to, hurt their feelings. And they said, Dad, there you go.
Gave it away.
No, we were talking about plug power and talking about Snowflake. And these killed you, even though I think they're great, because of levels. See, plug power, I don't know. I don't like the fact that he sold a lot of stock, Andy Marsh. We had to talk about that.
Yep.
But Snowflake's an amazing company. But it was selling for too much. But I like it now.
Yep. I think that goes back to the first question that we had, time to nibble on some of the high quality names.
You and I go back and forth. It's not just a process of my saying, Amazon 100. No, you don't do that. And I want people at home to get, maybe I have someone, maybe a brother, a sister, a mother, father, kid, where you can say, listen, I'm thinking about buying X. And they can say, wow, I don't know. I was listening to, I'm a member of the club, and people, they're saying, hey, listen, wait a little bit, but it's going to be okay. I want everyone to, and of course you can send us questions, and we can share everything with the club. So I guess. All
right, last one. We're going to go to Jeff in California, who asks, what are your thoughts on buying Ford now? The price to earnings multiple is very low. Can I start a position? Well, look, the multiple is as low as I've seen in a while. I think it's around 6 times now. It's got a 3.5% dividend yield. We've waited from buying more, so we did make a couple good sales. But a big one in 24 in January, another one at 15.50, because we knew this was the type of stock that was just going to get crushed when the Fed turned very hawkish.
Remember, we want to buy companies that make things and do stuff that return capital. So far, so good.
Yeah,
it's got all that are profitable. We don't know.
Really?
Well,
just the investments in EV.
Well, we don't know how much they're spending. And we don't know about the warranties. That said, the warranties are soon going to be behind them, and they should have a very good path to make ICE, internal combustion engines, and sell the Rivian. That will make it so they can afford to do their EV. So that's why at 10, where it traded last week, I was itching to start buying back. Even at unprofitable, we get, which I think it will be profitable ultimately because of how it's coming, you get a 3.5% yield. I'll tell you, a lot of these executives, now I don't do anything inside information, of course. A lot of these executives I talk to all the time. And I did send, as I said, I indicated at the top of the show, I did send Farley, the CEO, I said, maybe you got to bring back, take it easy. There's someone behind, on a flatbed Ford saying, and
the Eagles song.
Yeah. So then Lisa says to me, Jim, you can't do the flatbed Ford song anymore because it's about a girl waving at me. You got to stop that. But still, I went to Farley. I said, just do the song. Just do the song with a flatbed Ford.
I would love that.
Yeah,
that's one of my favorites. It's great.
I talked to him a lot because, I bought a Maverick for $38,000. It's tricked out. And I love it so much. He's a guy, he answers me. And this weekend, though, in Formula One, Ben Stoto informs me that it was Ferrari.
Yeah, Ford is not involved in Formula One.
No, we need them. McLaren. All right, so here we go. Let's just sum up. First, I do want to tell you, the morning meetings, I don't know if you caught them. I think they're fun. I think they're informative. and are a very good example of what I've been talking about, which is the clash of the minds. So I want you to continue to come to morning meetings. I want you to answer whether you'd be interested in perhaps being in what I want to call the essence of decision. The essence, which would be the morning meeting where I go at it with Jeff to see if we want to let people know. I also have some ideas about whether you'd want to come see us in Vegas. I don't know. Why not? I mean, geez, you certainly got the rooms. We don't play them this year.
No,
we don't play them.
Last year we did. Yeah.
And what I mostly want to do is stay in touch. And so does Jeff. We want your questions. We love them. We love being in the club. I told my wife yesterday, I said, we got a club meeting. The old days, I used to say, club meeting, so hard. Now I say we have a club meeting. I can't wait. And that's because of how great you people are. That wraps up what is always the highlight of my day. Hearing directly, not just my day, hearing directly from Americans and doing our best to answer your burning questions. Especially in times like these, it's important to remember we are together in this. If you missed anything or you want to go back and watch our meeting again, the full video on demand will be available right here at cnbc.com/investingclub/live at 2 p.m. East. I don't know. It's Monday. Can't go to the Elks. Too early in the week to drink. I got to be good. But I am going to fight for Constellation beers to be considered domestic so they stay at $3. Thank you very much. Thank you for coming.